Welcome to Caribbean Business Review, where insight meets impact. We bring you economic and financial updates, sharp statistical breakdowns, and data-driven insights on the forces shaping the region. Smart analysis, bold ideas, real Caribbean intelligence. This is CBR. Welcome to episode 9 of season 3 of the Caribbean Business Review. My name is Joseph Cox. First of all, let me thank you so much for your continued support across all our social media channels and MKR Radio. Please be advised that a new edition of the Caribbean Financial Dispatch is now available, and readers can now follow the dispatch at caribbeanfinancialdispatch.substack.com. This week on CBR, our special guests are Richard Rambaran, a Guyanese economist and Managing Director of Ascension Business Services, and Sherry-Ann Farquharson, Manager of Sustainable Development Services at Environmental Solutions Limited. We engage in a frank discussion on the new global energy shock and its Caribbean implications. A critical examination of how the global energy crisis is reshaping Caribbean energy policy, economic stability, and the region's long-term development strategy. And in today's CBR briefing, we discuss Caribbean food security and the preference gap. This briefing examines how global fertilizer shocks are exposing a deeper Caribbean food security paradox where policy ambition, agricultural production, and consumer preferences remain dangerously misaligned. Before we turn, however, to today's briefing, there is a development in global energy markets that deserves careful attention across the Caribbean. At first glance, the relationship appears counterintuitive. Oil price shocks typically weaken economies, yet in the Caribbean they can simultaneously strengthen government revenues. This reflects what might be described as a Caribbean revenue paradox. Across much of the region, fuel is among the most heavily taxed commodity in the national fiscal system. When global oil prices rise, governments often collect more revenue through fuel duties and consumption taxes. But the same price shock that strengthens fiscal inflows also drives inflation, raises electricity and transportation costs, and increases pressure on household budgets and businesses. With several Caribbean budgets already approved for the fiscal year, sustained volatility in global oil markets could force governments to revisit key fiscal assumptions in the months ahead. The question now is whether this latest energy shock will accelerate the region's transition towards renewable energy or simply become another reminder of a vulnerability the Caribbean has long recognized but has yet to fully escape. Against that backdrop, let's turn to the key stories that we are tracking this hour in our Market Watch and Global Pulse segments. Coming up in the Market Watch, Barbados records 2.7% real growth. Belize unveils $1.9 billion budget as debt ratio falls, and Jamaica's tourism recovery targets full capacity by December 2026. Then in Global Pulse, IEA releases 400 million barrels to stabilize oil markets, U.S. growth revised lower, and Canada loses 83,900 jobs in February. All that and more this hour on Market Watch and Global Pulse. Coming up next is a CBR briefing. This is your CBR briefing. Now, a conflict thousands of miles away may soon be affecting what appears on Caribbean dinner tables. As tensions escalate involving the United States, Israel, and Iran, attention has focused largely on rising oil prices and shipping disruptions. But another channel is emerging that could prove just as significant: fertilizer markets. Major producers, including Algeria, Egypt, China, and the United States, have already raised nitrogen fertilizer prices by between $45 and $70 per metric ton. Large volumes of fertilizer shipments also pass through the Strait of Hormuz, meaning any prolonged disruption to shipping could raise global food production costs. For the Caribbean, the implications are immediate. The region imports between 60 and 90% of its food, while local agriculture relies heavily on imported inputs such as fertilizer and animal feed. High fertilizer prices therefore affect the Caribbean twice. raising the cost of domestic production while also increasing the price of imported food. This vulnerability has long been recognized. For decades, Caribbean governments have launched initiatives aimed at reducing food import dependence. The most recent is the CARICOM 25 by 2025 initiative, which sought to reduce the regional food import bill by 25%. Yet progress has been uneven. The strategy has now effectively been extended as the 25 by 2025 plus 5 initiative, acknowledging that the original targets will not be achieved within the intended time frame. Similarly, agreements such as the St. Barnabas Accord linking Barbados, Guyana, and cooperation with Suriname proposed ambitious agricultural partnerships. But several of the agreement's flagship initiatives, including a regional food hub and expanded transport connectivity, have yet to materialize. The Caribbean has produced many food security initiatives. What it has struggled to produce is consistent implementation. But there's another challenge that receives far less attention in the regional policy debate. It is behavioral. Across much of the Caribbean, roughly 60% of the population is under the age of 40, a generation shaped heavily by global media and international food branding. For many younger consumers, dietary habits increasingly align with international fast food culture, where convenience, branding, and visual appeal plays a powerful role. By contrast, many indigenous Caribbean foods such as cassava, breadfruit, yam, the sheen, plantain, etc., have gradually lost visibility in the modern urban diet. This creates a structural paradox. Many of the crops best suited to Caribbean agriculture are precisely those traditional foods that are less prominent in contemporary consumption patterns. While governments encourage farmers to expand production of root crops, fruits, and vegetables, consumer demand increasingly favors imported wheat-based products, processed foods, and branded fast food items. In effect, the Caribbean is attempting to build food security around crops that younger consumers are increasingly less inclined to eat. In other words, the region faces not only a production gap, but also a preference gap. In simple terms, food security policy must consider demand-side economics. Another element that receives surprisingly little attention is presentation and culinary innovation. Traditional foods are often promoted through cultural heritage narratives, yet relative little effort has been devoted to modern interpretations that appeal to younger consumers. In a globalized food culture shaped by branding, design, and visual appeal, presentation matters. After all, people often eat with their eyes before they eat with their mouths. Without renewed attention to culinary creativity and product development, many traditional crops may struggle to regain relevance in contemporary diets. Until Caribbean agriculture and Caribbean diets begin to move in the same direction, the region's food security will remain exposed to external shocks, from fertilizer prices to geopolitical conflict. Now that's your CBR briefing. This is your market brief. We begin in Jamaica, where authorities expect all 33,000 hotel rooms to return to operation by December 2026, while the country has secured more than 160,000 airline seats from the UK and Europe for summer 2026. Meanwhile, Carnival in Jamaica generated $7.7 billion in direct spending in 2025, producing an estimated $165.7 billion overall economic impact. In Barbados, the economy recorded 2.7% growth in 2025, with inflation averaging 0.7% and unemployment at 6.6%. Belize has unveiled a $1.9 billion national budget for 26-27, with public debt reduced to 66.6% of GDP, while the Cayman Islands now expects a $44.8 million fiscal surplus for 2025. Elsewhere, Bermuda has launched a new fintech strategy as the global cyber insurance market is projected to reach $37 billion in premiums within the next decade. In policy developments, the Cayman Islands is targeting new AI legislation by 2027, while Antigua has approved a phased increase in the national minimum wage from $9 to $13 EC per hour. Finally, Trinidad has confirmed a $1.8 billion development portfolio with CAF, while St. Lucia will maintain its CBI program despite changes to UK visa policy. Now that's your market brief on Caribbean Business Review. For more, look for us on YouTube and Spotify.
In a world of constant change, insight is your greatest asset. At Joseph Cox and Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox and Associates. Insight, experience, impact.
Okay, welcome back to Caribbean Business Review. My name is Joseph Cox, and today we're having a very special conversation. In fact, we deviate from our normal format, where we're going to have a bit of a panel discussion today as we look at the issue of the global energy crisis and what are the implications for us here in the Caribbean. Now, to help us with that conversation today, we have Richard Rambaran, who is an economist and is also managing director of Ascension Business Services. We also have Sherry-Ann Farquharson, who is a manager for Sustainable Development Services Division at Environmental Solutions Limited. Now, folks, as I welcome you to the program, I think it is incumbent on me to raise a couple of points, as it were. Because looking at the thing right now, West Texas Intermediate and Brent crude, they're hovering around 100. In fact, Brent is over 100. Yeah. And the OPEC, the 2-day average is roughly 120. 80, airline, hear me, jet fuel is up 81% since the start of the war, up 124% since the start of the year. We're looking at Qatar has declared force majeure on some of the LNG plants, which now going to put a lot of pressure on the LNG prices on the spot market. Fertilizer prices have jumped by up to between $45 and $70. All in all, folks, what it creates is a very uncertain climate. And indeed, I will start with you first, Richard, and then I'll come to you, Sherry-Ann. And Richard, my question to you is simply this. We in this region, we have experienced multiple energy shocks over the years, right? Multiple. At what point does it become a policy failure versus a structural vulnerability? Which is it? Because we can't keep doing the same thing over and over.
Yeah. Thank you, Joseph. Good afternoon, and of course, good afternoon to your listeners from Guyana, and thank you for interviewing me. Very poignant and very important topic. Now, though we would have started the discussion around what is prevailing in the contemporary landscape, I think it's important in the medium-term historical sense to also adumbrate what it is that has happened. I think from around 2022, we would have had the Russia-Ukraine war, which really coming out of the COVID environment caused a change or an upturn in the energy market. That is one important segment that ought to be discussed as preface to the conditions that prevail right now. That is in the first instance. Secondly, of course, there were a number of sanctions and geopolitical tensions, which really arose from that and underscored fragmented energy markets within the global context. So that's the second important part. And then the third, just as a precursor, preconditions to this is, I would reckon to say when one looks at the overall investment globally in fossil fuel and in the petroleum sector, because of this discussion about energy transition and tightening a little bit on the supply of petroleum, there was a general structure or predisposition to underinvestment in petroleum. And so those factors acting in concurrence or consequently with what we have now really set the stage for petroleum prices being at about a 10-year high. If we are to look at the trajectory of history, that puts us, of course, in a unique position. Now, getting exactly to the point that you were asking, or exactly to the question that you were asking, I would say that structurally, our economies within the Caribbean, small, open economies integrated into the global architecture, will almost always face this problem of being price dependent, international price dependent, commodity price dependent, until and unless we make definitive decisions about how we deal with critical items such as our energy security. And so, whilst structurally we are oriented to being exposed to global vulnerabilities, I believe that over time, perhaps as a Caribbean region, we have not been as deliberate as we ought to be in terms of securing our energy future and our energy platforms, if you will. And so I would reckon to opine that it is a combination of the two, but emanating from the structural conditions that prevail in the Caribbean economies. Those would form my prefatory remarks on this.
Yeah, man, fine. And that's a fair comment. And now, Sherry, and I come to you because, and first of all, how does it feel to be on the other side of the mic? But anyway, I digress. No, but seriously, the question is, at this point in time, because every time we have a crisis, we hear the usual conversation. We should transition to renewable energy solutions and so on. There is usually a temporary response, but then after that, you relapse back into the same inertia that usually obtains. Is this time likely to be any different, or is this more of the same?
Boy, you're asking me to do some prophesying here. But Joe, I actually in preparation, I actually decided to make note of how many times we've been here before. So Richard mentioned the most recent ones, but 1973. So that's usually one of the big ones, and that is one of the key inflection points. Well, should have been one of the key inflection points for the Caribbean around renewables. And then there was 1979 into 1980 with the Iranian Revolution, and then that transitioned into the Iran-Iraq War. Then we had the Gulf crisis in the 90s.
Yeah.
And then we had sustained prices in 2011s. And then we got to the Russia-Ukraine shock that came after that. And now here we are. So if we could go back into history, the conversation we're having now really should have continued in 1973. Because I think the energy landscape in terms of the opportunities for the Caribbean are the same now as they were then. However, what has happened since, particularly since the 2011s into now, is that we're seeing deliberate efforts to actually set ourselves up for investment in our energy infrastructure. So there are a few things that have happened in terms of the regulations that will allow for the private investment, because there has been recognition that the governments cannot actually do this. So public-private partnerships, as well as facilitating certainty for private investment. We've seen that happening, and that needs to continue and to scale up in several of the cases, and even in instances where you've had success stories and then governments have lapsed and investment has taken a long time to happen again. We really can't take our foot off the gas. Another one of the things that we have seen is policy certainty. Those are some of the things that are required, because from the energy perspective, from the technological perspective, that is clear. I think what is really required now, we cannot take our foot off the gas as it relates to the enabling environment to make this investment happen. This is not something new, as we have said. It is, if it is not confirmation that we need energy security, I don't know what will be. So while I cannot prophesy as to whether or not this time will be different, we have a lot of the key ingredients to make a better kind of a cake this time around. And so we really need to just keep the foot on the gas and stick to that.
And if I can, just as a corollary to that, Joe, before you go, just one major thing too, I think that is different from the last energy crisis, which Sherry-Ann would have spoken about, to where we are now, is that we have two other Caribbean territories emerging as perhaps major energy producers within the Western Hemisphere. Of course, Guyana, where I'm native to, and then, of course, Suriname. We may see substantially the Caribbean's per capita production increasing consequently.
No, and that's a valid point. And indeed, I was coming to that a little later in the conversation. But before I get to it, I have a simple question for both of you. Where we at now, roughly $100 per barrel. I mean, we use the West Texas Intermediate benchmark, but which is 98. Let's call it 100. Is that price high enough that it will now spur investment in renewables? Or what is the threshold, do you think? I mean, I know it's just a best guess, or is a kind of threshold that would make the kind of investment really attractive?
So I suppose I'll go given the order of things. So I'll say this to you, Joe. I don't particularly think that there is a price threshold that will act as the linchpin or the real catalyst for it. What I think it will be is the intertemporal nature of that price rise, whether the price rise is sustained long enough to be able to pressure investment in that particular way, to say, hey, we don't ever want to be here again. I mean, if you look at the international financial markets and the discussions that are being had there, you look at the Financial Times, Wall Street Journal, etc. A lot of where the attention is being pointed to at this juncture is how sustained will these energy prices be, and for all intents and purposes, whether prices will, in this case, demonstrate to be sticky or downward rigid, if I'm to use economic theory's vernacular, if they will be sticky or downward rigid for a sustained period of time. So I think from my perspective, it's an intertemporal discussion, and to understand the longevity of the price rise and whether it pressures investment into that direction.
All right, fair enough. Sure.
So I'll add to that. So not just it being sustained, but I think the uncertainty as to what exactly is going to happen and where it is going to land. I think that should be enough. So outside of the dollar figure of whether 100 is the threshold, I think the conversation around the uncertainty of the pricing and how that is going to impact on the cost of living, how that is going to impact on inflation, how is that going to impact on all of the other things that depend on petroleum inputs, transportation. We've seen it before with the price of bread, when you think about the fertilizer and how that is going to impact on infrastructure. That uncertainty, I think, should be sufficient to really spur something lasting, because when you have policy where you hear, oh, this is the policy being shared via those short form communications, then I think that kind of environment should suggest to our policymakers that we need to do something to secure stability for our region.
No, but I hear you both, but one of the things that strikes me is that, frankly speaking, $100 a barrel, that is not something, frankly, even though Iran is shouting that it could go to 200, I don't think that is something that is going to be sustained over time. But frankly speaking, if, for example, countries like the Caribbean, for those tourism-dependent economies, anywhere between 15 to 85% of GDP is dependent on tourism, yes? No, the bulk of the tourists that come through with air. Well, some come through with cruise, but the bulk really comes through, or those that spend, the greatest spend, comes through air. If your jet fuel jumps 124% since January, and that is not an impetus for you to look to alternate solutions, I really don't know what could be. Honestly. That's the truth.
Yeah, and I definitely agree with you, especially as it relates to that. But I don't think all hope is lost. We haven't touched on the conversation around hydrogen, which is one of the things that has been, shown the most promise for those hard to decarbonize areas like air travel. And I know Trinidad has a strong hydrogen agenda that we really do hope translates into actual investment. So the studies are being done now, pairing hydrogen with wind, looking at decarbonization. We have smaller conversations around hydrogen in Barbados, though that is more around grid stability rather than looking at it as a fuel input into other areas. So as I said, a lot of the ingredients are there. It's about connecting the dots and making sure that, as you said, this is not sustainable. And when we are so dependent on tourism, then, we really need to look at how do we actually get persons in. And Joe, you and I have had other conversations around looking beyond tourism. I don't know if you want us to get into that now, because one of the things that I have maintained is that the same things that tourists come to the Caribbean for, the sun, the sea, the wind, and all of that, the mountains and the geothermal, all of those are inputs into energy that can translate into economic value for the region. So that's another conversation there.
I want to add another dimension to which I think is very important. We have had LNG in the region for some time, but I think the addition of Guyana and Suriname and the vastness or potential vastness of the LNG there really helps with this problem that we have of interconnectedness amongst Caribbean territories, and how we are able to then ensure that benefit which may arise from one country can also have concomitant benefits in sister Caribbean territories. Because LNG, as you know, is one of the most exportable forms of energy.
Yes.
Whereas if we were perhaps doing in Guyana onshore crude extraction, and we were taking the funds and investing that into some sort of wired electrical that is going across country, then that may put us in a different position. Though that is present, we do have this potential of LNG, whether it be piping, whether it be barging it, whatever the case is. And so maybe as a transitional fuel, that can be something that ought to be explored in the near future. But I think a lot of it has to do with our regional production and the regional capabilities that will arise as a result of all of this. If I'm not mistaken, I believe Barbados too is looking at perhaps making itself one of the additional energy frontiers, and let's observe and see what happens in that arc in the Caribbean.
Yeah, but I hear. Yeah, sure. Go ahead.
Yeah. So what we've traditionally seen in the region as it relates to trade within the region is that 40% of trade actually oftentimes goes out to one single market, and then you have to several others. So 40% of the trade is with the US market, and then you have to the EU and others. Just around 7% of trade actually happens between or governments in the region. And so that is a conversation that we need to have. Yes, we have suppliers in the region, but are we actually going to have those bilateral or regional trade deals that will allow us all to benefit from the expanse of resources in the region? I'm not sure
No,
where we'll go with that.
No, and that I think is a valid point. But they say at the same time, and as a corollary to what he's saying, one of the things that strikes me is that, for example, yes, Ghana has potential in terms of the supplies, etc., etc. Trinidad right now does not have that capability because they still have the challenge in terms of sourcing the gas out of Venezuela. So that is not so much. I mean, we have a challenge here. But on top of all of that, because of the force majeure that was declared in Qatar, there is no going to be greater push on the spot market prices, which everybody will have to start to look to. And at that point in time, I'm not sure how much of a solution that is, at least in the short term. I know that, for example, governments like Jamaica have been getting into more and more LNG. There's out of Dam Rep, right? But the fact of life is that as the market is now, how viable a solution would that be?
I'm not sure we have any short-term solutions, Joe. And
Okay.
I think that is one of the things we've put ourselves in that position. And where we do not have any short-term solutions. And so we have to think long-term. And I think that may be a part of why we are still here, because every time we've come upon this, we try to find a short-term fix. There really isn't a short-term fix. And so we really have to look strategically at how are we going to work together in the long term and keep working at it together.
All right.
And it also raises the very pertinent question as to, from a philosophical governance standpoint, as to whether there is a desire to work together, or if we are just in this all for historical reasons or path dependence. Is there this genuine desire for us to work together? Is it the most economically viable thing?
Those who follow this program know that I have very, very specific thoughts on that, because I think we are shooting ourselves in the foot, and the regional experiment is really under severe threat at this point in time, because there is obvious dissonance in the process. But Richard, let me turn specifically to you with this one. Coming out of this dynamic, this global crisis, there are likely to be two primary beneficiaries, which is Guyana and Trinidad. Yeah. Guyana more so, because with the price of oil jumping as it is, it becomes a paradox of a sort, because your revenue yields should jump and must jump considerably. Whereas the others,
the specific
no, but I'm going somewhere with this. But to the others now, here is where the other part of the paradox kicks in. For most countries, if not all countries across this region, a big part of petroleum, end user petroleum prices, are taxes. So therefore, their revenues also jump considerably during the period, right? Albeit that it is going to happen at the expense of the economic base, but nonetheless, that is the dynamic. Now, when you're caught in this sort of a conundrum, how do you actually move forward? And how do you see this really panning out over the medium term?
Yeah, so of course there's this specific term for that in international trade called the terms of trade paradox. I mentioned it to the media recently, and they carried it here in Guyana. I'll speak from one standpoint, I guess, as a Guyanese economist, and then I'll speak from another standpoint as a Caribbean economist. In the first instance, I think Guyana sets a very important example for the region to follow in two regards. One, Guyana has set out its Guyana Oil Company, which acts as the market leader to tell the rest of the private downstream operations where they should go in terms of prices. And so there is never this non-cooperative or cooperative oligopoly on downstream petroleum providers about holding prices high when it really ought not to be. Because oil in Guyana acts as the market stabilizing force. So that is in the first instance, and perhaps it may be an example for other Caribbean countries who have not had downstream providers to look at a similar model. That's one. Secondly, the government of Guyana very prudently adjusts our excise tax on fuel to be able to maintain at least some range of stability or some semblance of stability, and uses that as an economic lever, or as a fiscal lever more specifically, to ensure that the right prices, or at least reasonable prices, reach to the end user. Since 2022, Guyana first moved its excise tax on fuel down from, I believe, 30%. At this juncture, we're at 0%, and it has remained 0% for the past two fiscals. That is an incredible example, I believe, for the rest of the region to follow. There are a couple of other things that can be done. So, for example, if the oil company, if the downstream national oil company is one that is prudently managed and they are benefiting from surpluses, it can perhaps be in a separate fund, and that can then be used in times of downturn and essentially to smooth out commodity price cycles. So in this regard, I think Guyana represents a good example of how fiscal responsibility can translate itself into smoothing out price volatility and ensuring that commodity cycles and shocks that ensue are not tremendous. Guyana, in another instance, I've made the suggestion that if this is a sustained shock, there could be the possibility in Guyana's particular instance, given the sovereign wealth fund and the monies that are there. Part of the sovereign wealth fund is to help to stabilize situations like this. Perhaps provide even a small subsidy to fuel consumers, whether it be by way of the pump, whether it be by way of ensuring that you reach into negative excise tax, and so forth. So these are all levers that ought to be played with, and I don't think that responsible governments should be using this time to really extract high amounts of excise tax. It will flatline economies, Joe. You know that very well.
I know it quite well. No, but then you see, and Sherry, and let me bring you straight into this as well, because one of the things, following from what Richard is saying, one of the things that, for example, Greece, I'm not sure if you've heard about it, but Greece has introduced something whereby they put a cap on the profit margin that can be applied in terms of petrol products. And there is also, I believe, some sort of cap in terms of grocery prices and so on. Now, Richard is saying that the excise in Ghana is zero, right, on petroleum. We know that for the rest of the region, that is not the case. Now, we know the usual argument, to don't have the fiscal space because of the adverse dynamics, we have to be careful. Are those solutions viable from where you sit, Sharon? Are those viable in the rest of the Caribbean?
Yeah, I believe those are very viable solutions in the rest of the Caribbean, because when you're looking at sustainability, you can't just look at the income. You have to, and the economic side, you have to also look at the social side of it. And governments or political parties are in power to, get while doing good for the country, they're also looking to get back into power. So the social part of it is an important part of the dynamic. One of the things that I think this also creates an opportunity for is the conversation around one of the lowest hanging fruit, which is energy efficiency. Because in times of volatility, you're reminded that the cheapest barrel of oil is the one you don't have to buy. And so there are opportunities for you to look at that. And then when you don't have to spend the money on the oil, whether it is because of energy efficiency or you look at electrifying other sectors that you can power from renewables like transport, then that gives you back some of the fiscal space that you would in essence lose because of the reductions of what you're going to taking for on the petroleum taxes. So there are opportunities to balance it out when you look at it from a more holistic scale.
Yes.
No, but then, guys, when you look at, because we soon we have to start to wrap up. But when we look at part of the other part of the challenge, which is the logistics part of it now, the shipping costs. These costs are one from a logistics standpoint. I'm not sure in the post-COVID environment how much inventory is being held by our private sector, our manufacturers, etc. That's one. And two, in terms of the extraordinary jumps, both in insurance and the freight charges, I'm wondering what next? What's the next dimension that people should be really looking at in trying to treat with this issue? Because, I mean, just like how we'd have economies now, the usual response is, why are we not hedging against the oil? Right?
Yeah.
No, the obvious question is that at some point in the hedge, you're going to lose because the oil price going to drop and you're going to get
Jamaica
stuck with a
has
higher
seen
price.
that.
Yeah. So, I mean, when you look at all of this, what is the way, what's the path forward?
You want to take it first, Sherry?
Yeah, no, I can start. I can definitely start. I know we're getting into the wrap up, Joe, and I'll go back to where we started. We have all of the ingredients already. One, we cannot expect that we're gonna turn this around in a matter of days, weeks, or maybe even months. And so we cannot be discouraged and take our foot off the gas when the prices go back down, which they usually do. It is cyclical, but we do know they're gonna go back up again. And so energy security has to be a priority from a economic standpoint, right? Because most of us do not produce oil, we don't produce gas, but we have a lot of other resources that we actually can leverage and leverage much better. And so one of the takeaways for me is we cannot do what we've always done, because then we're going to end up here again in a situation where we have no control over and our best profits cannot predict. But we do know that it's going to happen again. And so we have to prioritize energy security and put everything in place to ensure that we are able to leverage that. As a regionalist, I do believe we go further together. And we have set up the regional institutions to allow us to pool our resources, to whether it is through the single market, whether it is through the regional organization set up to drive the energy transition, which is SICRI, whatever it is. We have all of these ingredients already. We cannot afford to go into a lull when the prices go back down, because we know that they will. And we also know that they will come back up based on the geopolitics of the world we live in. And that is something we have no control over. So let us work at strengthening the things that we actually have control over.
All right, I hear you. But then, Richard, let me bring you in now on a straight piece of economics. A number of countries, Guyana, Jamaica, St. Vincent, St. Lucia, in fact, most of the OECS, as far as I'm aware, have just recently concluded their fiscal budgets.
Yeah.
For a number of countries, they had priced the oil at roughly, I did the estimates on roughly $60, some tell you 70, but 60, 70 range. With what is going on now, are we likely to see a slew of budget amendments being brought to the fore?
Well,
can these budgets see?
Well, that is possible that maybe you may have supplementaries being sought, amongst other things. But like I would have mentioned at the beginning of the program, the intertemporal nature and the sustained nature of this price rise in fuel is really one of the most important aspects or elements of it. I think my genuine opinion on this for the Caribbean as a whole, and perhaps Guyana being excluded, maybe Suriname, once they get their production going, being excluded, is that we are in for some slowdowns in the Caribbean region. I think we're in for some slowdown, and it may be, should this be sustained, it may be one of those more painful types of slowdowns where it will really take a bit of innovation and some deliberate expansionary fiscal policy to kickstart the economic growth once again within the Caribbean, an economic growth rate that has actually been teetering along at not so impressive rates coming out of post-COVID. So I think two main things are the reasons for this. A is the apparent dependence on crude at an international level by the small open economies, and then secondly, as you would have rightly mentioned before, is what happens with jet fuel prices and that major impact on tourism that will be had. Additionally, in the developed markets, for the tourists coming to the Caribbean, they too may be facing some slowdowns.
Absolutely.
And that will in turn affect their purchasing power. So I think we're really in for a rough upcoming quarter in the Caribbean. I don't foresee that it will be all roses, because even if there is the price increase is not as sustained as it may perhaps be, you still do have expectations, you have stickiness of prices, you have stock inventory that may run out and will face the higher prices, which will make its way into another temporal cycle, and will impact on things. Just closing out, perhaps, because I know we're maybe at the end of the program, I'd want to identify that energy security becomes one of the paramount importance in the Caribbean region, perhaps over the next 2 decades. As we move into the global sustainable energy matrix and what that looks like. And this entire discussion around what is the right sustainable energy mix, irrespective of what political party is leading in the United States. At some point in time, it will have to be discussed once again, with or without the U.S. at the forefront, like they were in the last administration. I think it's very important. How do we as a Caribbean ensure that we utilize the growing economic nature of renewable energy? And how do we ensure that we capture that same sun? How do we ensure that we capture that same wind and transmit it, if not at least into base power, at least helping with some cream on top of the base that all goes some way. The other thing as well too, Joe, that maybe we should start discussing, and this is just me throwing something out there, in the thought process of an economic development story. Maybe we look at perhaps floating a bond in the Caribbean, which can be supported by our Caribbean territories, and that bond help to fund maybe modular refineries. That bond maybe can help to fund some amount of LNG transport, LNG platforms for export within the Caribbean. Those are things that I have not heard been discussed yet.
Quite so. Sherry-Ann, even though we're out of time, I give you 30 seconds. Last word.
Yeah, I think this is just another reminder that we really have to, as Richard said, this energy security has to be that chief priority for us. And as we look at diversifying beyond tourism, because I really do think that we ought to continue diversification of our economies. There's a growing need for energy as it relates to data centers and AI. And those Caribbean countries that have baseload power, like geothermal, or even when you look at solar plus storage or wind, hydro, there are so many other options that can supplement that to diversify our economies, so that when there are all of these shocks, there are still revenue opportunities that we don't have to be so concerned about if we have to make any adjustments with other taxes. So looking at, all of the opportunities, everything staying on board.
No, quite so, quite so. And at that note, we have to leave it there for this week. So my thanks to Sherry Ann Farquharson, who is a manager of Sustainable Development Services Division at Environmental Solutions Limited, and Richard Ramaran, who is an economist and a managing director of Ascension Business Services right there in Ghana. Thank you so much to both of you for your interventions. And that's how we have to leave this conversation for today. So thank you all so much.
Thank you. Thank you, Joe.
Thanks for having me, Joe.
This is your Market Watch. In Bermuda, the government has launched a 2026 to 28 fintech strategy aimed at strengthening the island's position as a global digital finance hub. The plan focuses on insurtech development, digital identity infrastructure, and regulatory innovation to attract international investment. Cayman Islands' public finances have improved sharply, with the government now expecting a $44.8 million surplus for 2025. The turnaround reflects tighter expenditure controls and stronger revenues, particularly from property transactions and stamp duty collections. In Barbados, the economy recorded 2.7% real GDP growth in 2025, with inflation averaging 0.7% and unemployment at 6.6%. International reserves remain strong at roughly 27 weeks of import cover. Lease has presented a $1.9 billion national budget for fiscal year 2026-27, with revenues projected to rise 8.5% year-on-year. Public debt has declined to 66.6% of GDP, down sharply from more than 130% in 2020. In Trinidad and Tobago, Development Corporation with CAF, the Development Bank of Latin America and the Caribbean, continues to expand. The country now holds a $1.8 billion portfolio supporting infrastructure, digital development, climate resilience, and export financing. Meanwhile, Antigua and Barbuda has approved a phased increase in the national minimum wage from $9 to $13 EC per hour over 3 years to address rising living costs. In Jamaica, tourism recovery continues, with the government expecting all 33,000 hotel rooms to return to operation by December 2026. The country has also secured more than 160,000 airline seats from the UK and Europe for summer 2026, while Carnival in Jamaica generated $7.7 billion in direct spending in 2025, producing an estimated $165.7 billion in total economic impact. In St. Vincent, where energy imports exceed $200 million annually, rising oil prices could push electricity surcharges higher and intensify inflation pressures. And finally, in St. Lucia, authorities are preparing to import water from Dominica to address supply shortages, highlighting growing infrastructure and climate resilience challenges across the region. But before we wrap, here's a quick look at regional currencies and stock market performance. The CARICOM exchange rates remain broadly stable, with the Bahamas, Barbados, and Belize maintaining their long-standing pegs, while Jamaica trades at $158.16 to the US dollar, Trinidad at $6.76, Suriname at $37.75, and Guyana at $2.18. Haiti's gourd traded at $131.61. On the equity side, Caribbean markets were mixed. The JSE index advanced 0.45%, and Trinidad's All-TNT index edged up 0.17%. BISX and BSE advanced marginally, while most other regional indices traded firm. The Caribbean Exchange Index advanced by 0.22%. Top gainers were Epley Caribbean Property and Pulse Investments, which jumped by 12.4% and 11.5% respectively. Top losers were 138 Student Living and Margaritaville Turks, which declined by 17.4% and 16.8% respectively. Now that's it for your Market Watch. I'm Joseph Cox. Global Pulse is up next. This is CBR. This is your global pulse. Energy markets remain volatile as conflict around the Strait of Hormuz disrupts one of the world's most important shipping corridors. The route normally carries around 20% of global oil supply, but tanker traffic has fallen from more than 120 vessels per day to fewer than 10, sharply constraining exports from the Gulf. Production disruptions are emerging across the region. Iraq's southern oil output has reportedly dropped nearly 70% to about 1.3 million barrels per day, while Kuwait has begun shutting down its production as export capacity tightens. Saudi Arabia is rerouting some shipments through its east-west pipeline to the Red Sea. Oil markets have reacted sharply. Brent crude briefly approached $120 per barrel, while jet fuel prices have surged to between $150 to $200 per barrel, prompting several international airlines to raise fares. The International Energy Agency has agreed to release 400 million barrels from strategic reserves, while G7 finance ministers say additional measures remain under consideration. In China, exports rose 21.8% in January and February, driven by strong shipments to Europe and Asian markets. A separate survey of foreign firms found 45% ranking China as their top investment destination, while 75% plan reinvestment in 2026. In the meantime, China's central bank extended its gold buying streak to 16 consecutive months, lifting reserves to 74.22 million ounces. In the United States, consumer inflation held at 2.4% in February, while mortgage rates rose to 6.19%. Fourth quarter U.S. GDP growth has been revised down to 0.7%, reflecting slower consumer spending and exports. In Europe, officials warned that sustained oil prices near $100 per barrel could lift inflation above 3% next year and slow economic growth. In the meantime, the UK economy recorded 0% GDP growth in January, down from 0.1% in December and below forecasts of 0.2%, according to the Office of National Statistics. Services output stagnated as recruitment and hospitality activity declined, while manufacturing fell 0.1% and construction rose 0.2%. And finally, Japan's economy expanded at an annualized 1.3% in the fourth quarter, while Canada lost 83,900 jobs in February, pushing unemployment to 6.7%. But before we close, a quick look at our global markets. Energy prices moved higher amid Middle East tensions. West Texas Intermediate crude rose to $98.71 and Brent crude to $100, while the OPEC basket jumped more than 15% to $120.90. Natural gas, however, slipped 3.15% to $3.13. Equity markets were broadly weaker. In the United States, the Dow Jones fell 0.26%, the S&P 500 declined 0.61%, and the Nasdaq dropped 0.93%. European markets also closed lower, with Germany's DAX down 0.6%, France's CAC 40 off by 0.91%, while in Asia, Japan's Nikkei fell 1.16%, and Hong Kong's Hang Seng declined 0.98%. Now that's it from the Global Pulse. I am Joseph Cox. This is CBR. Well, that's a wrap on episode 9, season 3 of Caribbean Business Review. Well, thank you so much to our loyal audience across MKR Radio and all our digital platforms for your continued support. As always, we stand by our mantra that knowledge is strength, but information is power. Our special thanks to Richard Rambran, economist and managing director of Ascension Business Services, and Sherry Ann Ferguson, manager, Sustainable Development Services at Environmental Solutions Limited, who helped us unpack how the global energy crisis is reshaping Caribbean energy policy, economic stability, and the region's long-term development strategy. Now, some of the strategic takeaways from the discussion are: 1. Dynamic energy security. Caribbean resilience requires agile energy systems, policy certainty, and long-term renewable investment rather than dependence on imported fossil fuels. 2. Structural vulnerabilities. Small island economies must diversify beyond tourism while addressing import dependence and building more resilient, sustainable economic structures. And 3. Regional cooperation and innovation. Shared infrastructure, public-private partnerships, and emerging technologies like hydrogen can accelerate the Caribbean's long-term energy transition. Now, the latest edition of the Caribbean Financial Dispatch is now live, shared on LinkedIn, on your WhatsApp statuses, and via the link in our YouTube comments. Readers can now follow and subscribe at caribbeanfinancialdispatch.substack.com. You can also listen to this episode at your convenience on Spotify. Don't forget to like, share, comment, and subscribe, and follow Caribbean Business Review on TikTok, Spotify, YouTube, Facebook, Instagram, X, and LinkedIn. Until next week, same time, same place, I'm Joseph Cox, and this has been the Caribbean Business Review.